That guaranteed financial product, the one promising security and steady returns, often hides an insidious secret. It was designed to quietly drain your wealth, not build it, leaving you holding a bag full of regrets while its creators pocketed your future. You were told it was safe, predictable, a bedrock for your retirement, perhaps even bulletproof. But what if the very guarantee you sought was the most expensive part of the deal, secretly siphoning off your capital, not just through explicit fees, but through a labyrinth of hidden costs, lost opportunities, and structural disadvantages that no one ever bothered to explain? We live in a world where complexity is often mistaken for sophistication, especially in finance. You see an advisor, a friendly face, someone who speaks in soothing tones about protecting your assets. They present a glossy brochure filled with charts that only ever go up, and they utter the magic words: guaranteed returns, principal protection, tax advantages. It sounds like an impenetrable fortress for your money, a sanctuary from market volatility. But those very words, those siren songs of safety, are frequently the first sign that you're about to enter a financial arrangement where the house always wins, and you, the investor, are destined to play the role of the house's perpetual revenue stream. Think for a moment about the concept of whole life insurance as an investment. For decades, it's been sold as the ultimate financial two-for-one. Life insurance coverage combined with a cash value component that grows steadily. It sounds perfect, doesn't it? Protection for your family and a growing nest egg, all in one neat package. Yet the reality is far from this idyllic picture. The moment you sign up, a substantial portion of your initial premiums, sometimes for the first 2 years or even more, doesn't go towards building your cash value or even directly funding your death benefit. No, it vanishes, devoured by the commissions paid to the agent who sold you the policy, and by the administrative costs of the insurance company. This is money that never works for you, money that's simply gone. I've seen countless individuals, earnest and hopeful, pour their hard-earned money into these policies, believing they're making a smart move for their future. They watch their statements, sometimes for years, seeing glacial growth in their cash value, all while believing they're accumulating wealth. What they don't realize is that the guaranteed growth rate, often quoted as a modest percentage, is applied to a cash value that has already been significantly reduced by fees and internal charges. It's a trick of mathematics, where a small percentage of a smaller number looks like progress, but in reality, it's barely keeping pace with inflation, if at all. It's like running a marathon where the starting line keeps moving further back. Then there are the annuities, another favorite of those seeking guaranteed income in retirement. These are contracts, usually with an insurance company, where you pay a lump sum or a series of payments, and in return, you receive regular disbursements, either immediately or at some point in the future. They come in so many flavors: fixed, variable, indexed, each with its own dizzying array of terms and conditions. The allure is strong, especially for those who fear outliving their savings. But peel back the layers of complexity, and you'll often find a similar pattern of wealth erosion. With variable annuities, for example, your money is invested in sub-accounts that are essentially mutual funds, and these come with their own management fees. On top of that, you pay additional fees for the annuity contract itself, including administrative charges, mortality and expense risk charges, and fees for any riders, those optional benefits like guaranteed income or death benefits that sound so appealing. I've seen these combined fees easily reach 3% or more per year. 3% of your entire principal, year after year, vanishing before your investments even have a chance to grow. If the market gives you 7%, you're really only seeing 4% before taxes. Over decades, this difference is staggering, turning what could have been a comfortable retirement into a constant struggle. What about liquidity? That's another silent killer in many of these guaranteed products. You put your money in, expecting it to be there when you need it. but try to access the cash value of a whole life policy early and you'll run head first into surrender charges, a penalty for taking out your own money. These charges can be substantial, lasting for a decade or more, and they ensure that the insurance company recoups its upfront costs, often at your expense. Annuities frequently have similar surrender periods, locking up your capital for years, sometimes with no access at all without incurring significant penalties. Your money is held captive, working for someone else, while you face a steep ransom to get it back. I often ask people who feel trapped in these products, did anyone fully explain to you what would happen if you needed that money for an emergency, or if you simply changed your mind? The answer is almost always a hesitant no. The focus is always on the promise, never on the practical realities of accessing your capital. It's a sales tactic designed to secure your money for the long haul, because the longer they hold it, the more fees they collect. This isn't about helping you, it's about optimizing their revenue. Another insidious example manifests in certain types of actively managed mutual funds. The pitch is compelling. A team of brilliant financial minds with access to exclusive research and cutting-edge strategies will beat the market for you. They promise superior returns, the kind you can't get from simply tracking an index. And for this specialized expertise, they charge higher management fees, often 1% to 2% of your assets annually, sometimes more. It sounds reasonable. After all, you're paying for performance, right? The uncomfortable truth is that the vast majority of actively managed funds consistently fail to beat their benchmark indexes, especially after factoring in their higher fees. Studies show this again and again, year after year. The extra cost of those brilliant minds eats directly into your returns, creating a significant drag on your long-term wealth accumulation. You pay more, but you get less. It's a lose-lose proposition for the investor, but a consistent win for the fund managers and the institutions that market these products. They don't want you to know this simple fact because it dismantles their entire business model. You might be asking, but if these products are so disadvantageous, why are they so widely recommended? The answer often lies in incentives. Many financial advisors, especially those who aren't fiduciaries, operate under a suitability standard, not a best interest standard. This means they only have to recommend products that are suitable for your situation, not necessarily the best or lowest cost option. And guess which products often come with the highest commissions for the advisor? That's right, the very products we're discussing: whole life policies, annuities, and high-fee mutual funds. Imagine a doctor who gets a huge bonus for prescribing the most expensive drug, even if a cheaper, equally effective generic exists. You'd be outraged, wouldn't you? Yet, in the financial world, this practice is not only common, but often perfectly legal. The advisor benefits handsomely from steering you towards these products, while you, the client, slowly bleed value over time. Your financial health takes a back seat to their sales targets. It's a fundamental conflict of interest that few people truly grasp until it's too late.
Then there's the psychological trap, the quiet whispers in our minds that keep us tethered to these draining investments. It's the sunk cost fallacy. I've already put so much money into this, I can't pull out now. Or the fear of missing out. What if it finally turns around and I miss the big growth? The financial industry preys on these innate human biases. They understand that once you've invested time and money, the emotional hurdle of admitting a mistake and cutting your losses becomes incredibly high. They count on your inertia, your hope, and your reluctance to confront an unpleasant truth. The truth is, sometimes the smartest financial move is to admit an error, take your lumps, and move your money into something that actually serves your long-term interests. But this requires courage and a clear understanding of the real costs, not just the perceived ones. It's about recognizing that holding on to a bad investment simply because you've already invested in it is like digging a hole after you've already fallen in. Consider the often overlooked cost of opportunity. Every dollar you have locked up in a low-performing, high-fee product is a dollar that isn't invested in something more efficient, more transparent, and ultimately more profitable for you.
If your whole life policy is growing at a guaranteed 2%, while a diversified low-cost index fund consistently returns 7 to 8% over the long term, you're not just losing 2% a year. You're losing the difference between what you did earn and what you could have earned. This opportunity cost, though invisible on your statement, is one of the most powerful wealth destroyers over decades. It's not just about the explicit fees you pay, but the implicit wealth you forego. This often reminds me of a conversation I had with an older gentleman, a kind, trusting soul named Arthur. He had invested heavily in a municipal bond fund because his advisor swore by its tax-free income. Arthur, being diligent, proudly showed me his statements, highlighting the consistent dividend payments. But when we dug deeper, we found the fund's expense ratio was remarkably high for bonds, and its total return, after all costs, was barely keeping pace with inflation. He was effectively just getting his capital back slowly, year after year, with almost no real growth. He thought he was being smart about taxes, but he was losing the war against inflation and fees. His purchasing power was eroding, and he didn't even realize it. Inflation itself is a silent, insidious bleeder, especially for products that promise guaranteed but low returns. If your so-called safe investment guarantees you 2% annual growth, but inflation is running at 3%, you're losing purchasing power every single year. Your money is numerically increasing, but its real-world value is shrinking. This isn't just about preserving capital. It's about ensuring your capital can still buy you the same lifestyle or better in the future. Many of these guaranteed products, while protecting your nominal principal, completely fail to protect your real purchasing power. They guarantee you'll have a number, but they don't guarantee that number will actually buy you anything useful. Then there are the esoteric structured products, often branded as bespoke investments for sophisticated investors. These are complex financial instruments tied to the performance of underlying assets, like a stock index, commodities, or interest rates. They often promise principal protection or enhanced returns under specific market conditions. But their complexity is a feature, not a bug. It makes them incredibly difficult for the average investor to understand and even harder to price fairly. Embedded within their intricate structure are layers of fees, often opaque, that benefit the issuer.
The upside is usually capped, meaning you only participate in a fraction of the market's gains, while the downside protection often comes with significant caveats. You give up the potential for substantial growth in exchange for a convoluted safety net that might not even catch you when you fall. The very word guaranteed should trigger a red flag, not a feeling of security. Because in finance, guarantees almost always come with a price, and that price is usually paid by you, the investor, in the form of reduced returns, hidden fees, or forfeited liquidity. Who is doing the guaranteeing? What is their incentive? And what are the conditions and fine print that invariably accompany such a powerful promise? It's rarely a simple, unconditional assurance of prosperity. More often, it's a meticulously crafted illusion designed to maximize the issuer's profit at your expense. We often fall for these products because we fear uncertainty. The stock market feels risky, volatile. We crave stability. But true financial stability doesn't come from chasing guaranteed mediocrity. It comes from understanding risk, diversifying wisely, and minimizing costs. It comes from owning investments that are transparent, liquid, and aligned with your long-term goals, not the sales targets of an institution. This is a fundamental truth that the banker's vault has always emphasized. The less you know, the more they profit. So, how do you protect yourself from these financial vampires that promise a helping hand but secretly siphon your blood? The answer is shockingly simple, yet profoundly powerful. Educate yourself, question everything, and prioritize transparency and low costs. Look for investments that are straightforward, easy to understand, and where all fees are clearly disclosed. Embrace index funds and ETFs that track broad markets with minimal expense ratios. Seek out fee-only financial advisors who are fiduciaries, legally bound to act in your best interest and who are compensated directly by you, not by commissions from product sales. Your investment journey should not feel like navigating a complex maze. It should feel like building with strong, clear blocks. Don't be swayed by glossy brochures or the smooth talk of guaranteed returns. Instead, demand clarity, challenge assumptions, and understand every single line item that impacts your money. Your financial future is too important to leave to products designed to bleed you dry through hidden costs and complex structures. Take control, simplify, and reclaim the wealth that was always meant to be yours. The secret isn't in finding the most complicated product. It's in embracing the profound power of simplicity.